The UK pound sterling moved a little bit higher, but later came down, and gilt yields also inched down on news of much higher fiscal buffers revealed in Rachel Reeves' autumn UK budget. You could call it a measured response from hard to please markets. The judgment of the Office for Budget Responsibility (OBR), which inadvertently leaked the report ahead of the budget, was that the budget barely affects the economy. None of the policy changes, according to the OBR, will have a significant effect on the UK's long-term growth potential. On the contrary, higher personal taxes, reducing incentives to work could have a slight negative effect. Budget measures may help to reduce inflation, but only in the short term, according to OBR. Rachel Reeves, UK Chancellor, ahead of revealing a much-awaited budget, said she was committed to a budget that cuts NHS waiting lists, that cuts UK debt and borrowing, and also cuts the cost of living. So far, all she had accomplished was unseating Liz Truss's Kwasi Kwarteng as the most unpopular Chancellor since polling began. There are four main stakeholders to please, though she clearly focused more on the public and markets. First is the British public. They want all their goodies and wallet buffers kept intact. Markets want to raise cost of borrowing, that is bond yields, if the numbers don't add up. And of course, they want new goodies properly funded, usually by tax rises than by more borrowing. But you also have the party politicians, 400 or so Labour MPs, who want to stay in power and do not need a fiscal heroin ruining things. Then, of course, the usually grumpy, almost always dissatisfied business sector, who will say they want to create jobs, but also want to smile to the bank and their shareholders, and who, of course, fear, perhaps justifiably so, that they will be an easy sacrifice to fund higher welfare spend. Reeves earlier had announced that the minimum wages were going up for over 21s by 50p an hour to £12.71 in April 2026. For workers aged 18 to 20, the minimum wage will rise by 85p. For 16 and 17-year-olds and apprentices, the minimum wage will increase to £8 an hour, up from £7.55p. An existing sugar tax, which mainly applied to fizzy drinks, will now be extended to milk-based drinks. The UK government will, thanks to the budget, have almost £22 billion in fiscal headroom in 5 years' time, according to the OBR, much higher than what they said in March when they forecasted the headroom, that is the amount of extra spending or tax cuts possible, while staying within the government's self-imposed budget rule. They said the headroom then was £9.9 billion. So there's been quite an improvement in fiscal headroom, which shows that this budget clearly prioritizes markets and fiscal consolidation, financed mostly by the £26 billion of an array of tax rises, especially on the entrepreneurial and wealthier class. The largest tax rise comes from freezing the income tax and national insurance thresholds, which of course brings more into the tax net. Reeves had said in her first budget last year that she would not extend the freeze. Hello, this is a special edition of Global Business Insights focused on the UK autumn budget and some of the implications, especially for business.
The previous Conservative government froze personal tax thresholds from 2021 to 2028. And today I will maintain all income tax and equivalent national insurance thresholds at their current level for a further 3 years from 2028. At the same time, we are ensuring that people only in receipt of the basic or new state pension do not have to pay small amounts of tax through simple assessment from April 2027. I will also keep the Plan 2 student loan repayments threshold at its 2026-27 level for 3 years. Madam Deputy Speaker, I know that maintaining these thresholds is a decision that will affect working people. I said that last year, and I won't pretend otherwise now. Madam Deputy Speaker, I am asking everyone to make a contribution, but I can keep that contribution as low as possible because I will make further reforms to our tax system today to make it fairer and to ensure that the wealthiest contribute the most. The Conservatives knew that our tax system didn't work. Time and time again, they ducked the necessary reforms, leaving a system unfit for a changing economy, with unfairness that they refused to address. Currently, a landlord with an income of £25,000 will pay nearly £1,200 less in tax than their tenant with the same salary, because no national insurance is charged on property, dividend, or savings income. It's not fair that the tax system treats different types of income so differently. And so I will increase the basic and higher rate of tax on property, savings, and dividend income by 2 percentage points, and the additional rate of tax on property and savings income by 2 percentage points. Even after these reforms, 90% of taxpayers will still pay no tax at all on their savings. As well as narrowing the gap between the tax on income from assets and income from work, I also believe that a fair society is one where the wealthiest pay their fair share. The reforms I made last year will raise an additional £8 billion a year by 2030 from wealth. I increased taxes last year on private equity, private schools, and private jets. I abolished the non-dom tax regime. And this year, I will make 2 changes to cap trust charges and prevent avoidance. I reformed inheritance tax on agricultural and business assets. And this year, I am aligning those reforms with wider inheritance tax rules by allowing the transfer of the 100% relief allowance between spouses, balancing the taxation of these valuable assets with the realities of family life. In this budget, I will take further steps to deal with a long-standing source of wealth inequality in our country. A Band D home in Darlington or Blackpool pays just under £2,400 in council tax, nearly £300 more than a £10 million mansion in Mayfair. And so, from 2028, I am introducing the high-value council tax surcharge in England, an annual £2,500 charge for properties worth more than £2 million, rising to £7,500 for properties worth more than £5 million. This will be collected alongside council tax, levied on owners, and we will consult on options for support or deferral. This new surcharge will raise over £400 million by 2031 and will be charged on less than the top 1% of properties. Madam Deputy Speaker, reliefs in our tax system cost the taxpayer billions of pounds a year, but many of them no longer serve their original purpose. The government rightly provides generous tax relief for people paying into a pension, relieving income tax on all contributions and on the investment itself, as well as national insurance relief on employer contributions at a cost of over £70 billion a year to the Exchequer. This budget makes no changes to those reliefs or to the tax-free lump sum. But salary sacrifice for pensions, which was intended to be a small part of our pension system, is forecast to almost treble in cost to other taxpayers from £2.8 billion in 2017 to £8 billion by 2030, with the greatest benefit going to the highest earners, or to those in the financial services sector putting their bonuses into pensions tax-free, while those on the minimum wage or those whose employers don't offer salary sacrifice don't benefit at all. That is not sustainable for our public finances, putting pressure on the tax that everyone else pays. And so I am introducing a £2,000 cap on salary sacrifice into a pension.
Markets should be delighted, but what did other stakeholders get from the budget and from the OBR assessments. The income tax and national insurance thresholds freeze also draws more on depleted wallets. The two-child benefits cap to be lifted next April is the biggest plus in the budget from the perspective of people wanting more support for poorer households. Freezing fuel duty till next September and also a rail fare freeze supports strained wallets. The government also hopes to use these fiscal measures to contain transport costs and energy household bills, thus hoping to reduce inflation. A high-value council tax surcharge on properties worth over £2 million is now going to be imposed, and that would raise about £400 million. Of course, that's a tax on the wealthy. Business and entrepreneurs will not be pleased with higher tax rates on dividends, property and savings income by 2 percentage points, raising £2.1 billion. Reducing the writing down allowance, that's the main rate in corporation tax, which raises £1.5 billion, will also hurt businesses. Writing down allowance is a type of capital allowance that allows businesses to deduct a percentage of an asset's value from taxable profits. The biggest downer punishing entrepreneurs and small businesses is the 2% increase to the basic and higher rates of dividend tax to be enforced from April. The basic tax rate will rise to 10.75%. This will hurt investors in shares, as well as many small company directors who pay themselves a minimal salary to reduce income tax combined with more generous dividends, which are taxed at a much lower rate. That is about to change. The EV market was not spared, as a new mileage-based charge on battery, electric and plug-in hybrid cars from April 2028 is expected to raise about £1.4 billion. That was just announced also as part of the budget. More taxes on online gambling will also raise £1.1 billion, and reduced capital gains tax relief on disposals to employee ownership trusts will also raise £0.9 billion. But there are other lessons on the process. First is need for caution about making promises with major fiscal implications, which will depend on a hard-to-predict context. Voters expect promises to be kept. Freezing thresholds was something that Reeves explicitly said only a year ago that she would not do, as it hurts people. The numbers also show, given the buffers that they have, that she did not exactly need to do it, although you could argue that you do need those buffers for the rainy day. Second, the budget is not just late, but the mostly negative speculation has been unprecedented, and that, of course, has depressed business sentiment to such a low it would be almost impossible to recover. It's good to prepare the ground, but stoking more uncertainty and encouraging unnecessary speculation is a minus from the perspective of how stakeholders will judge the process. Thirdly, Rachel has focused on laying the blame for an inherited fiscal mess on Brexit and on a more harrowing geopolitical environment requiring more defense spend. Perhaps these are, of course, true, but the narrative has been dominated by these headlines and far less on the debate to grow the economy. I would add that judging budgets only by market reactions such as gilt yield movements is not always constructive, as it focuses on short-term factors. My conclusion is that given the headroom she actually had based on latest forecasts, there was no reason for such an aggressive tax rate that could hurt economic growth and depress sentiment, and of course breaks her own promises and the Labour manifesto pledge. Well, that's it on this special episode of Global Business Insights. Thanks again for watching. This is Bode Oshosani. Bye-bye.